Today we have a real treat for our audience. We have Dr. Mark Stephenson, Director of Dairy Policy Analysis at the University of Wisconsin-Madison. Dr. Stephenson is an internationally recognized expert on dairy economics and worldwide market trends. He brings both a national and international perspective to dairy markets for us, and he'll break it down for us today what it means for dairy producers here in the Northeast and beyond. He'll cover regional, national, and international markets and talk about what the coming year might bring for us. So without further ado, I'm going to turn it over to Mark.
I want to start out this outlook this year by just saying up front, we've got a better outlook for the year ahead for sure. And 2019 has been quite a lot better than 2018, as all of you would know. But I do say this in the title here with a couple of asterisks, meaning that there are a couple of those little footnotes that we probably should be aware of, things that could perhaps put a forecast like this off the rails just a little bit. But I don't think that that's likely so much in this year, and I think actually it's more of a positive forecast all the way around. I wanted to start out by looking at the economy. Economy is important to dairy because as the economy is strong, we find that we have robust demand for dairy products as well. Clearly 2009 and 10 were poor years for us when in the dairy industry, milk prices declined a great deal. And we had unemployment in that recession that hit 10%. As you've noticed in this chart, we have unemployment rate now that's down at 3.5%. It's at a historic low level. This is not way beyond, but well beyond what economists would consider to be full employment in the United States. And as most of us would probably know, labor's been difficult to find in many job sectors. So the economy's been strong, and that's a good thing. But I'm going to put one of my first asterisks right up front here. And this is just a comment on the general economy. This is one of the things that macroeconomists like to take a look at. It's treasury bill rates for both a long-term bond, a 10-year rate, minus a 2-year treasury bill. And you look at the difference between those two things, it's often called the spread. This has been a good predictor of recessions. They sometimes call where we're at right now an inverted yield curve. And that's because you want long-term interest rates to be much higher than short-term rates. That's a good indication of a positive view of the future. Inversion, where short-term rates are actually higher, is almost always a guarantee of problems. And the place that our economy is at right now is strongly hinting of recession, or at the very least, that we're at the top of the business cycle. A 10-2 inverted yield curve has preceded every US recession that we've had over the last 50 years, and that's been 7 of them over that time period. There's been one false positive. We can hope that what we're looking at here in this chart is a false positive, but I think we've got a few other things that are concerns. Now, I also want you to take a note and see that when we get that inversion, when the blue line is dropping below that heavy black line in the middle of the graph, that's the actual inversion there, that it's usually 10 months to a year before we actually have recession, which is indicated by those vertical gray bars. So I don't think that the recession is imminent, and I'm not even sure we'll have a recession. Hopefully it's just a slowdown in our economy. And I know that Washington can do many things to kind of pull on the strings of an economy for the short term, at least, to do some things. And I think that they will pull on every string that they've got as we're going into elections, and probably after elections or by the beginning of 2021 is when we may really begin to feel like we're actually in recession. I also expect that we can see some slowing of job growth, and that's another indicator of a pending recession. There are some economists that are expecting job growth to be slowing by the 3rd quarter of 2020, and consumer confidence has been dropping a bit. I'll show more about that in the next slide. So these things, I think, are pointing us toward an economy that is going to slow its growth under the best of circumstances, and maybe even be negative growth. Here's the consumer confidence chart that I had hinted about. That red line in there is the consumer confidence number that you will often hear quoted monthly in newspapers or news articles. And you can see that that's been growing since our recession in 2008-9. But this has two components to it. The survey that's done monthly is a telephone survey where they ask consumers, how do you feel about the economy today? And how do you feel about the economy in the near future? That's the expectations on here. That red line that's consumer confidence is the combination of the two things, or the average actually of those two things. If you look at the 2006-07 time period that preceded our last recession, you'll notice that the present situation seemed very good. People said, you know, they felt great. Their 401k programs had been big and were looking very generous at the time, but they were concerned about the future. That's the green line. And, you know, if you get concerned about the future, your spending may begin to slow down a bit. And when spending slows down, you can actually pull yourself into recession. That's part of what happened in 2009. But after we got into the recession, you'll notice that the present situation was poor, but people were confident about the future. And so that begins to pull us back up and out. If you take a look at where we are today, at the end of 2019, early part of 2020, you'll see that spread between the present, where we feel great about today's economy, but we have concerns about the future, is bigger than it has ever been. So I'm a little bit concerned that we're going to find consumer spending slowing down. And we already see some of that. There is a negative trend for business confidence, which is different than this consumer confidence. There is an index that's called the ISM, the Manufacturers Index, Composite Index, and that's beginning to show some of those signs that manufacturing is slowing down too. Also a concern for the economy. Here's a graphic that's just showing you a little bit about why it matters. This is a chart that's showing you how much of the gross domestic product, the measure of the economy, is actually made up of the consumption phase of it. You'll notice on the left-hand side, the US has about 71% of our GDP that's made up of consumption. And if you look at clear the other side of this graph, a country like China has very little of their GDP that's made up of consumption. A large portion of what China has in terms of gross domestic product is a result of investment. So, you know, they're pouring a lot of concrete, they're building structures, they're doing some things, and that's different than consumption. It's not that either one of these characteristics is right or wrong, but having a high degree of your GDP dependent on consumption has implications. If we stop consuming or slowing down consumption quite a bit, it has a much bigger impact on our economy than it does an economy like, say, China. This chart is busy, but let me see if I can just unpack it a little bit for you. It's showing two things. On the left-hand side, it's showing you the percent of US milk production that is being sold as exports, and that's in the blue line on the graph. On the right-hand side, I've got the US all milk price, and that's being shown in the orange line on the graph. And I kind of want to draw your attention to some correspondence between these two different series here. We started to export significantly more product back around 2003, 4, 5, in that time period. And that trend has been generally upward. That's the blue line is basically moving up. But anytime that we've been off that trend, whether it's been relatively flat like it was in that 2002 to 4 time period, or actually significant decline like it was in 2009, you can remember that those were also time periods when our milk price dropped a long way. And that's the kind of time frame that we've been in over here clear on the right. Since 2015, our milk price had dropped a great distance. It's recovering somewhat now, not back to where we would like it to be, nor fully recovered yet, but coming back. And much of that has to do with our export opportunities. If we're either off trend or actually declining for whatever reason, that 2009 time period was a result of recession, and it was global recession. It wasn't just a US recession. So some of the folks we were selling product to overseas just simply said, I can't buy as much as I did before. And when that happened, it stayed here on our shores, and that had to be absorbed into our marketplace. And the first thing we see, of course, is that storable dairy products like cheese and butter and non-fat dry milk, inventories begin to increase. And as soon as that begins to happen, we get a lot of downward pressure on price to clear the markets. So these are indications of some of the volatility we have in our milk prices, what's happening with exports. Since we've become a major exporter, they do have an impact on our milk price. Here is what we have seen. In 2014, highest milk price ever. And then we began to have some of these exports falling off. And you'll see here in 2015, the green line at the bottom, that our stocks of cheese began to rise. Now, it's normal for us to build stocks during this flush season of the year, which is kind of March, April, May, even on into June. And then stocks normally decline for the rest of the year as we pull them down. But that didn't happen in 2015. In 2016, the orange line, they continued to build. 2017, that purple line, they had more of a normal pattern of build and drawdown, but they were still at much higher levels. 2018, they continued to build through the year, but finally in 2019, they started to draw down. And that's why I'm showing this little bubble over here that says some optimism. These stock levels are now not feeling as burdensome as they did before. There's still plenty of stocks, but we're getting down to a level that feels more comfortable, I think, to a country. So that's why we've had some strengthening of our class 3 prices, because cheese prices have had room to improve. The butter stocks also have a very seasonal pattern, and there wasn't much difference in the pattern, except that the levels of stocks began to build. Now, the scale of this chart makes it hard to see, but if you look clear over on the right-hand side and in that red line of 2019, you'll notice that we've got more butter stocks now than is typical for us. And that has put some pessimism into the markets for butter and caused butter prices to decline. And of course, in milk checks, that's going directly to your butterfat values. So as these butter stocks have been a little bit heavy, that's a problem. Let me see if I can give you a little bit of insight as to why that's been happening. This chart is showing you on a US dollar average corrected for exchange rates and that type of thing, and butterfat values, actually, global butter prices. So in the blue line, we see the European Union butter prices. In the green line, we see Oceania, meaning Australia, New Zealand butter prices. And in the red line, we see US butter prices. Now, these can't be too far out of alignment, or else we're going to not have sales opportunities for butter. And in fact, if their US prices are higher than our import or our other export competitors, we, for a long enough period of time, we become a potential buyer of products. And that's what's happened over 2019. Our prices were enough higher for a long enough period of time that the European Union started sending butter our way, and quite a bit more butter than they normally do. And that has pulled our butter prices back into a better alignment with global prices by dragging our prices down. If you take a look at cheese prices, we've had a bit of the same story. Now, we can sustain higher prices for a short period of time with not any real problem, but when they get to be too much of a difference for too long, we start getting reeled back in again, and that's where we are right now. This graph isn't as close to being current as some of the other price graphs are, and it's not showing us the fact that our cheese prices are beginning to converge a little bit better, but we're still above other world competitors for these markets. So our prices can't get very far out of alignment as long as we're going to be a major exporter. Let's look at a change in milk production. This is a percent change from a year earlier level, and very normal for the US to have something like a 1 to 2% increase in milk production. And generally speaking, we can handle that quite comfortably. Our domestic population grows and demand for dairy products per capita has been growing. And so somewhere between 1 and 2% is very comfortable growth, and maybe a little bit more than that if we have export opportunities. But you'll notice that since about 2016, we have been declining in our growth of milk production, and in fact had some months in early 2019 when milk production was below year earlier levels. It's fairly circumspect right now, about 0.5% growth the last month that we had reports. So our growth is slowed, and because of that, we haven't had to have exports back up at 18 or 19% of milk production to have price recovery. A big part of price recovery has happened because milk production growth has slowed here in the US. Let's take a look at the components of that milk production. Cow numbers. In 2016, even though milk prices had already declined quite a bit, we still saw increases in milk or dairy cow numbers. We had more farms beginning to exit the industry at that point, but most of the cows were just going down the road to another farm, and our total inventory of cows continued to grow. That happened also through 2017. Cows numbers built. To some extent, farms wanted to sell more milk, even if milk prices were somewhat lower, just because it helped with cash flow and paying bills. But by the time we got to 2018, we had to say uncle, and those cows that were now being sold when farms were sold were going to slaughter, and we reduced the cow herd. Same thing has continued, but not quite at the same pace in 2019. So our cow numbers have come back to a more comfortable level. Milk production per cow has a strong seasonal pattern. You can see the flush up here in April, May, and June, and keep that in mind because I'm going to come back to a comment about the flush a bit later. But productivity on our animals grows essentially year after year after year. And we've had growth this year, but it's been a little bit more modest. And frankly, this is one of the things that I'm wondering about as we go into 2020. I'm not sure that we're going to sustain all of the growth in productivity that we normally do, in no small part because we've been short of forages in some parts of the country, like the upper Midwest, and the quality of forage has not been great in other parts of the country, including the upper Midwest. So major milk producing regions have had some challenges, and I understand that that's true in the Northeast as well. So I think milk per cow per day is going to be coming back. This cow loss that we've had has also been measured in farm loss. Now, not every state gives us the number of licensed dairy farms on a monthly basis, but Wisconsin does. So I'm putting that up here to just give you an idea about what's normal for us and what's been happening over this prolonged downturn in prices. 2016 showed a fairly normal herd loss for Wisconsin. Somewhere between 3.5% and 4.5% is typical. But by the time you got into 2017, that rate began to grow. Certainly true through 2018 and 2019. And by the time we closed the year, Wisconsin dairy farms were being lost at a pace of 10%. That's huge. I went back to look at annual rates of farm loss, and this is the biggest one that we have recorded over a long period of time. So this is a big farm loss, and I know that we see this in the annual numbers in other states. Last year, I think Michigan lost farms at the rate of 13%. New York lost farms at an increased pace. So this has been happening across the country, with maybe a couple of exceptions. If you take a look at this regional change in milk production, it's not just farms or cows, but it's milk production. So that's what I'm showing here. We don't have fourth quarter numbers yet, but this is showing you the change from the first 3 quarters of 2019 compared to those same quarters in 2018. A little bit of increase in New York and a little bit in Vermont, but many of the rest of the New England states and Pennsylvania have all been down, and sharply down. So milk production has not really been growing very strongly in most parts of the country. The Southeast, truly big declines in milk production, with the exception of Mississippi and Georgia and a little bit from Florida. Texas has been the state where we've seen high and protracted growth. So that state has been increasing milk production at a pretty big rate. Let's take a look though at not just the US, but the world as well. Here is a chart that's showing you in the red line the US change in milk production on a percentage basis, but I'm also showing this in that dashed black line for 5 of the major exporting regions of the world. That includes the European Union, that includes New Zealand, Australia, Argentina, and the US. And that trend has been downward sloping ever since 2017. So we've had an impact, not just in the US, but we're sharing the pain around the globe. Some of it has been weather related. We've certainly seen a bit this last year in the US, but the European Union has had 2 persistently hot, dry summers. And the weather patterns in Oceania have been not always conducive either to milk production. And of course, we've all read about the headlines in Australia with the fires that they're having now. Certainly weather and climate related, they're having a difficult time. But this tightening in milk production is having an impact around the globe for availability of milk production. The European Union has had a policy that was available to them to use, and it was pretty similar to the policy that we used to have and use. Ours was called the Product Price Support Program, where the government would buy dairy products off the market to try and shore up milk prices, and then would sell them back when prices improved. In the European Union, they call that intervention. And they would intervene in the marketplace to buy products like skim milk powder. And those stocks had gotten huge and stayed that way until this last year, 2019, when the EU began to sell those stocks off at a rapid clip. Those stocks are gone now. And it's the fact that those stocks are gone that has given skim milk powder the ability to rise on world market prices. And we've seen our class 4 prices rising as a result of that as well. So that's been a good thing that we've worked some of those stocks down internationally. I want to shift gears just a little bit and move into dairy products and talk about demand for some of those for just a few minutes. The demand has stayed strong for US dairy products domestically. And part of the reason is that they're still a good buy, and consumers generally are enjoying those, with some exceptions that we can talk about in the next slide. But in 2014, when we had the highest farm milk prices ever, we also experienced the highest retail prices for all dairy products. This is the Bureau of Labor Statistics Index of dairy and related dairy products. And as those farm milk prices came down, you can see that retail prices also came down with it, not by the large dollar amounts that we see at the farm level, but the supply chain, all the way from processors up through retailers, tries to buffer these price swings to consumers to the extent that they can. And they'll take some of those profits back as prices are recovering a little bit. And at any rate, we've had prices that have been good for consumers, and purchases of domestic dairy products have been good. This has been the exception. Fluid milk sales, they continue to slide. Boy, 2010, it's hard to say why was that the year when things began to fall apart. And of course, I hear a lot of people say, well, of course, it's plant-based beverages. Sure, that's part of the reason, but it's not the whole reason. We've had plant-based beverages long before that, and you can still see that we've had this big slide in consumer total sales of fluid milk products. And that continues to this time period, this day. And, we've had some obvious headlines recently about Dean and Borden bankruptcies. This has been a real concern for the dairy industry, and it looks like that segment of the dairy supply chain isn't healthy. There's several things that relate to that. For one, the margins, the profitability in the fluid sector are historically thin. They just is not a lot of profit there anyway. It's a big volume product, but not a great deal of profit on a per unit basis. And we've had some of these declining sales due to competing beverages. As I said, not just plant-based beverages, but water is a major competitor to fluid milk, or has been in recent years. We've also had some demographic headwinds, and by that I mean that we're an aging population, and the biggest milk drinkers are children. And as we're having smaller families and the population growth is slowing, that means that we just don't have as many of our big milk drinkers available to be demanding milk. And we've also had some changing preferences out here. It's not all bad. Some of it has been okay, but it's different. Good example is we've seen a big decline in cold cereal sales. Cold cereal is a good companion product for dairy. When I grew up, we always had 2 or 3 boxes of cold cereal on the breakfast table every morning. That was breakfast, and you put milk on it. I don't do that anymore. Seldom have cold cereal, but I do go to the refrigerator and I grab a carton of yogurt. And I've shifted categories. That's bad news for fluid milk sales, but it's not necessarily bad news for dairy products. And my bottom line footnote down here is this doesn't reflect the overall health of the industry. In fact, if you look at some of these product categories, American cheese and other cheese have been growth categories for the dairy industry. Yogurt has been until just the last couple of years, when those sales have tailed off, but you can see in there that the 2000s have basically been good for yogurt, and even more recently, butter sales have increased quite a bit. If you look at per capita consumption in the US on all dairy products, the milk equivalent was the highest last year that we've ever had. And we've are still consuming more dairy products per capita, and of course the population grows too. It's just that not all categories have enjoyed the same growth potential that, say, cheese has. You look back here in the mid-1970s, we're talking about 14 pounds of cheese per capita. If you look over here last year in cheese category, we exceeded 38 pounds of cheese consumption per capita. So enjoy cheese. With the Super Bowl here, we can still grow that category, I'm sure. Let's shift gears once again, talk just a little bit about trade. Hopefully, today we're going to be seeing a sign of the Phase 1 agreement with China. China still has a lot of opportunity for growth. Their per capita consumption is small compared to world average, maybe about 75 pounds of milk equivalent per person, compared to a US average of 640 pounds and a world average of about 111. China has also had a lot of exits of dairies, and their small dairies are exiting faster than their mid-size and large dairies are growing. So they've had a couple of years with contracting milk production. That's not been great for them domestically, but it does offer opportunities for export sales. And historically, they've purchased quite a lot of U.S. dairy product, particularly whey and lactose. And we hope that this phase one trade agreement makes a difference. We don't know the details of it yet, but China purportedly has committed to purchasing a lot more agricultural products. That would certainly include dairy products if they're in there. And we also expect that this USMCA will be signed by the US here in the next week or two. We'll see. But Mexico and Canadian agreement, USMCA, will provide some slightly improved access to Canada. And with Mexico, we fought our way back to free trade that we had under NAFTA. So there's some positivity in that. I don't think we would look at that and say, you know, this is going to put dollars back in dairy producers' milk checks. It's going to be decimal points that this moves. But China has a lot more potential for us. Let's take a look at a couple of charts from USDEC. If we look over on the left-hand side here, this bar chart is showing you that the last year, 2019, the volume of dairy products traded by the U.S. to export destinations was down. So this was not a great year for exports from the standpoint of volume. But if you look all the way over here on the right-hand side, you'll see that this is showing you the value of those exports. Value is actually up. So we sold less product, but the price was higher, so the value of U.S. exports was higher. And you can see a bit of what was going on here. Whey was clearly a down volume export. So was skim milk powder, non-fat dry milk powder. Cheese up a small tick, butterfat was down. Let's take a look at disentangling this by some of our customers. Mexico has begun buying dairy products a little bit later in the year here in 2019, but essentially their production or their purchases of cheese were down. They're our largest customer, so we want to keep Mexico happy. On the other hand, South Korea, Japan, the Middle East, North Africa, Central America, and Southeast Asia have all been up. So our cheese exports are small, but they've been improving with a number of countries, and I think that's a very positive sign. Same thing has been true here for skim milk powder, except that in this case, it's down across virtually all of our major customers, not by a lot, but by a little bit. And finally, whey exports. This is really a story of China. Some of this, of course, was the retaliatory tariffs on whey products, but some of it has also been the African swine fever. By all reports, their swine herd may be down by as much as 40%. A lot of whey and lactose is fed to the swine herd there. So as that gets rebuilt, we may have more opportunities for export to China. For dairy farms that are looking at maybe culling the herd a little bit, the alternative to milk production has not been great. The cull cow price is way off levels that it was at in 2014 and 15. And maybe it's okay. We've kind of been used to this over a long period of time, being in that $40 to $60 range, but it's not great compared to where it was in 2014 and 15. So culling cows has not been a pleasant experience. There have been some other factors though. This last year, our Farm Bill brought some major changes to the margin protection program in the way of the dairy margin coverage program. And it's a promising risk management opportunity for dairy farms, especially smaller dairies. In 2019, the net benefit, and that's net benefit over all the milk produced for tier 1 level, if you bought up at $9.50, was about 40 cents a hundredweight. So this is considerable contribution to the bottom line of farms that are under that $5 million level or 5 million pound level of tier 1 production. But we aren't projecting any payments for 2020. Genomics has also been breeding, allowing herds to breed low-end cows to beef bulls, and that's provided us fewer heifers in the pipeline. So even if the milk price does look better, it's going to be hard for us to grow the herd at a very rapid clip. people are learning, I think, to not keep more heifers on hand than they really need for replacements, because raising heifers is expensive. So let's provide an opportunity to put them into the beef market. Some of the larger producers around the country, as I've spoken to them too, are not really looking for expansion opportunities like we've seen in other downturns and recoveries. They're more circumspect this time around. So I think that we're likely to see a modest increase in milk production this next year. And the more general economic downturn that I started talking about was the one thing that could temper my expectations for more complete price recovery. This is my price forecast graph. Dashed lines are showing you where I'm expecting the all milk price to be, and the blue line is class 3 and the red line is class 4 milk prices. I'm a bit more optimistic than futures markets are, and even a bit more optimistic than the USDA is in their WASDE reports. But I'll give you some reasons why I'm more optimistic. We are going through a milk price downturn right now, but that's because the buying season, major buying season for cheese and other dairy products is done. That's Thanksgiving through Super Bowl, and people have the product that they want already committed or sold and used, and stocks look adequate to even lightly burdensome, I would say. So nobody's at a big jump to get in there and buy dairy products right now. That's why prices are falling. They're going to wait and see if they can't pick up product at a slightly better price. Contributing factors to my outlook is that I think we've seen slowing US and world milk production. We've got declining US and world dairy stocks, relatively strong domestic economy out here, and our trade improvements, I think, are looking up. Some of those negative factors, though, is that these trade negotiations have been going on for a year and a half, 2 years. They're prolonged. They've been painful, and I don't expect our phase 1 China agreement to, tomorrow just say that we've got many shiploads of whey moving to China. I think it's going to be slow before we get some of those commitments for sales, but we'll see. We've also got slowing GDP growth in countries like China, and economies in Europe like Germany, France, and UK have been pretty weak and even close to what we would technically call recession. That's a bit of a concern. And if we see this possibility of US recession, this maybe is a domino that starts to knock over a few of the other economies as well. That's a big concern. It's not just the US. 2009 happened as a major recession because many of the world's economies were in recession. So we hope that doesn't happen this time around. Let's just have slower growth. My forecast, this is going to be an important thing, and I bolded it so you could see it. Watch the flush this year. We've got enough stocks right now. Nobody is antsy about getting their supplies locked up early, so that's why milk prices are declining over the next couple or 3 months. But as we start to move into the spring flush, this is the next key piece of information that the markets want and need to decide how exuberant they need to be about prices. If the flush is light, and by light I'm defining that as being maybe 615 pounds of milk production in the US per day during April and May, then I think we can expect buyers to bid up prices early and perhaps quite high. If it's heavy, that means like 620 million pounds of milk per day in that time period or above. Price strengthening is going to be slower for the year. Doesn't mean it'll be a bad year, but it's not going to be as good as what I'm forecasting right now. I'm projecting the 2019 all milk price to be up by about $2.35. We won't have that until we get closer to the end of this month with great precision, but we're within pennies of that right now. And I think that absent a recession, we could expect to see another $1.30 improvement for the all milk price in 2020. I also think that we could hit $20 milk again this next year, and my forecasts are showing that that's a possibility. We've had a fundamental structural change in the dairy industry. This has been a tough 5 years. The reasons are different than we had back in the 1980s, but I suspect we're going to look back on this time period and recognize that this was as seismic a change to an industry as we had back then. This is going to take quite a while. I think the farm loss that we've been seeing this last year is going to have a long tail on it. Even though milk prices are improving, we've still got a lot of farms whose balance sheets are so damaged that it's going to take some time before they could either restore that, and many of them are still going to be exiting the dairy industry. Not rushed out, but nevertheless, we'll see that they need to have a graceful exit. So I think it's going to take a little while before we settle back into a new equilibrium. And with that, I would call it to a close on my presentation, but Chris, if we have some, I'd be happy to answer questions.
I'll ask you a couple of questions now, and then we'll have Tristan do a brief presentation, crop insurance and risk management, and then we'll have some final questions after that point. Any more thoughts on plant-based dairy products? Certainly you mentioned that they've been around for quite a while, or at least some of them have. But in the last couple of years, we've seen a lot more prominence of them in retail stores and that sort of thing, predominantly in fluid milk, but alternatives to cheese and alternatives to ice cream even.
You know, I think that that's been a focal point for a lot of people in the dairy industry. And I'm not saying that it's been an insignificant impact, but it's one of the smaller ones for the fluid category. And it can continue to nibble away at us. One of the things I would really urge a fluid category to do, and it's not easy, so it just sounds like, oh, well, of course, you know, go out and innovate. You guys haven't been doing that. It's hard to do, but it's possible. We have seen some products like Coca-Cola's Fairlife that have had some real growth in sales, and I think that's, you know, a good thing to happen. Even within our state-old fluid milk sector, we've seen increasing sales of products like full fat, you know, or whole milk. So there's been some rebound there. Skim milk and low percent milks, butterfat milks, are the ones that have taken most of this on the chin. You know, we need to continue to look into those categories. Longer term, I'm a bit more concerned about the possibility, and I don't know if we can become cost competitive, but of synthetic milks, you know, the milks that would be created in a lab. If those milk proteins that they're making are indistinguishable from the ones secreted by a cow, then, you know, it's a bit more of a concern. If you really, you know, have a consumer preference that just says, I'm not going to consume animal-based products, maybe that's an alternative that has some of the flavor and characteristics that they really want without, you know, entertaining the cow. But that's many years down the road, I suspect.
Okay, thank you. What do you think about the impact of cooperatives' supply management efforts for their members in terms of the supply response to the current and projected milk prices? Do you think we'll see the kind of increase in production that we've seen in past price cycles?
We've seen a bit of a bump recently as these prices have gotten better. I'm quite sure that farms want to sell as much milk as they can, you know, when we've got $20 milk or better. We've got bills to pay down. We've got credit that needs to be restored. And there's going to be an urge to do that, but I think that it's going to be harder to do. For one thing, some of our expenses for people that are short on high quality forages, boy, high quality dairy forage hay is really short and very expensive right now. So I think that that's going to keep things a bit in check. The other thing is that farms are just a bit more circumspect again about growth in this cycle, at least from what I'm hearing and observing with larger operations. Doesn't mean that we aren't going to see some growth, but I don't think it's going to be pouring lots of concrete. And, you know, there are two places, Chris, where I see that happening. One is your co-op may impose discipline just to say, look, we can't get a good price for your product without shipping milk long distances that's that's not a recipe for a healthy dairy sector. So we may have programs in place, and we may even pull the trigger on those programs, as has happened there in the Northeast recently. I also suspect that people, the lenders, at least here in the upper Midwest, are being a little bit more careful about this too. Just saying, we need a letter from your handler saying that they're happy to take your milk. That in and of itself can be a bit of a throttle on rapid growth too.
Do you see any possibility for milk pricing reform in 2020, since Class 1 is becoming less and less important? And I think they're talking about like the federal milk marketing order pricing system.
It's going to be awfully hard to ignore federal order and regulatory questions in this year ahead. For one thing, it's been a long time since we've had a hearing that looked at make allowance issue. And, it's been a tough 5 years for dairy farmers, but it's getting to be a tough decade for processors that haven't had any relief in a make allowance either. So at some point in time, we're going to have a hearing, and at that hearing, maybe we have an expanded hearing that allows more questions than just a make allowance issue. Maybe we look at bigger issues like price discovery. Maybe we look at issues like just how many classes of dairy product we have, and how heavy a burden Class 1 can carry. The other thing that's not completely obvious, I think the whole sector of fluid milk has had some real challenges and issues, but there are also going to be just some personal issues about the firms that have declared bankruptcy. It's not just about consumption. That's part of it, but some of it is just about the structure of the firm itself and the kind of debt that it's carrying.
Okay, thanks. I'm now going to pause the questions and turn things over to Tristan Peterson for a relatively brief discussion of risk management programs and crop insurance programs, and how producers might be able to lock in some of these improved prices that Mark talked about in his presentation. So Tristan is the Northeast marketing agent for our crop growers crop insurance division. He's been with the company for 3 years and is extremely knowledgeable on dairy revenue risk management programs. So with that, I will turn it over to Tristan for a brief discussion, and then we'll return to questions for both Tristan and Mark.
I just want to take a couple minutes here just to talk about the opportunities that we have with the positive outlook that Mark talked about. We're seeing a lot of good prices in the futures right now, and how can we take an active role to look at the futures and develop a risk management plan that we can really utilize and take advantage of in the up and coming years, or up and coming year. So with that, let's get started. So DRP highlights, what I'll kind of do is we'll step through the program, just what options producers have to make, and how the program can really help producers of all sizes and all different breed types to best accommodate each individual producer. So DRP provides protection against sudden declines in quarterly revenue from the milk sales. So quarterly based insurance program, we look at calendar year quarters. So January, February, March would be Q1, so on and so forth. So with those quarters, we can look at the prices and insure up to 5 quarters into the future. So as far out as, or as far out as the risk management agency has established that pricing for. For example, right now on class pricing, we can insure Q2 of 2020, so April through June of 2020, all the way through Q1 of 2021. So we can actually establish prices into 2021 at this point in time. The pricing options that we have available are class pricing. We'll take a look at that example here on the next slide, and then a component-based price option. So with the component-based price option, we use producers' individual on-farm component values. So your actual butterfat test and your protein test to establish a milk price for the given quarter that we're looking at insuring. Producers, you guys as producers get to choose how much milk production you want to cover during the given quarter. So unlike some other programs that we see, dairy margin coverage, which Mark mentioned, that's an FSA program. With that program, there is a tier system, tier 1, tier 2, but we still have to enroll all of our milk at one of the price options, whether it's $4 coverage or $9.50 coverage. So that's an all-in program. And then LGM, which is our other risk management option through crop insurance, with that, there's a cap on the total hundredweights that we can enroll in a given time frame. So with this, we can put as much milk in or as little milk in as we want to. We can protect 80 to 95% of the price, the futures price that we look at, in 5% increments. So we'll see that in the next slide also. And then it's indexed using a state level milk production. So to be a crop insurance program, we have to have a yield adjustment factor in there to differentiate it from futures options that we can purchase in the open market. So we'll go through that also. So what I want to do quick is just run through a class pricing example and take a look at kind of what we've got going on here. So I talked about the options of class 3 and class 4 price. So circled in red there, we can see that. And then the expected price. So these prices are released daily. We can take advantage of the futures prices that we see in the market on a day-to-day basis from 3:30 in the afternoon till 9:30 the next morning. So this is run as of the 10th. On January 10th, we saw a class 3 price for quarter 2 of 2020 at $17.35 a hundredweight and a class 4 price at $17.79. So if we take a blended average, 50-50 average, we're actually looking at a class 3, class 4 price of $17.57. Over here to the left, we see the levels. These are the levels that we can lock in that price. So when we see $17.57, we can actually secure a $16.69 milk price for quarter 2 of 2020 for a cost of 7 cents a hundredweight. So in the grand total of things, if we're insuring 1 million pounds of milk, we're looking at $166,000 of guaranteed revenue on class 3 and class 4 futures for a cost to producer on 1 million pounds of milk of $770. So that just kind of shows us what prices we can see. If we look at Q4, so quarter 4 of 2020, on the bottom there, and you follow the same circled areas, we see the 95% coverage level now jumps to $17. So we can insure a $17 class 3, class 4 price for 16 cents a hundredweight. So why we look at this program, as Mark talked about a little bit earlier, the volatility in the milk price. We saw that graph early in his slides of kind of where that volatility was. And with the program, we can start pulling some of that volatility out in the futures markets as long as the futures allow for that. So some of the program requirements for DRP, we've got a yield adjustment factor in there. I talked about that. With the yield adjustment factor, just think of it fairly simple as a small influencer in what happens to your actual indemnity or the check you get if there's a claim. So if the yield adjustment factor drops below 1, so if the state or pooled region is 5,000 pounds, we see the example there, and the actual production comes in at 5,100 pounds, we see a yield adjustment factor of 1.02. So with that increase in the yield adjustment factor, we're going to see a decrease in any potential indemnity. So since you made more milk as a producer, you got paid more in your check, they're going to lower that indemnity on the back end. 2 other quick program requirements. So with being able to choose as much milk as we want to insure in any given time frame, we have to provide records for 85% of that milk. So providing records for that, fairly simple, just to have the milk checks. If we enroll 1 million pounds, we've got to be able to provide records for 850,000 pounds. And then on the component levels, if we use a component level to insure the milk, we have to meet 90% of that component level. For example, if we enroll a 4.0 butterfat, we have to have records to provide at least a 3.6 butterfat. So those are the program requirements quick. What's covered and what's not covered. So covered is the decline in the milk price. So this is a dollar-based program. We're covering dollars. So not covered is unfortunately loss of a milk market. I know as we've seen some different co-ops and different organizations file for bankruptcy. We don't protect against the loss of the milk market or the death or loss of cattle. So in summary, what dairy revenue protection does is it establishes a floor on the milk price. We're not sacrificing any upside potential. So if milk prices keep going up, as Mark kind of hinted to there for 2020, we're not losing any money besides the cost of the program, that 7 cents a hundredweight. A big thing that we tend to look at is knowing the cost of production. So if we know what our on-farm cost of production is, we can establish a risk management plan around that cost of production. If we're at a $17 cost of production, we can insure over $17 milk. That's very beneficial to producers at that point. This is a government subsidized program, so there is premium support. That's why we saw that it was highly affordable. Low premium cost, 7 cents a hundredweight to protect that high dollar price. Work with a crop grower's agent or consultant to determine how these prices relate to your on-farm milk check. One of the big things that I like to do with my producers is pull the check apart, make sure that we're seeing the basis in the check above the class 3 and class 4 prices, and we really understand the movers in that check, such as PPD and some of that stuff. And then lastly, call to action. So developing a relationship with an agent that understands your business. Work with somebody that is looking forward to helping you succeed in the near future and build that sound risk management plan. If you work with an agent, establish an application for DRP. With the application, you've got access within Farm Credit to some different tools to help you make the best decision possible. So no premium attaches until you actually enroll some milk. So if you file the application out, you can have that outstanding until you find a milk price that best works for your operation. And lastly, is set a target price. So with knowing our cost of production, we can establish target prices that we know it makes sense to enroll some milk after that point to protect our operation in the future. So with that, I know I kind of ran through that quick. With that, I'll hand it back over to you guys so you can take it from there.
Okay, thanks a lot, Tristan. So I think it's important to convey that producers can do a catastrophic type of coverage for very little money, or if they want to get more aggressive, if you will, and locking in a higher floor, they can do that at a relatively affordable rate as well, correct?
Yep. We can establish and create some different plans to make it super affordable for producers to still have some sort of coverage out there.
And you or your colleagues at Crop Growers would be happy to walk a producer through some of these rather complex options.
Yeah, most definitely. We like to spend the time on farm with producers to make sure they truly understand the program and kind of what they're signing up for, what they're looking at. It's very important to work with those producers to make sure that they understand all the moving parts, the PPD, how the basis affects the milk check, all of that sort of stuff. So, yep, all it takes is one phone call into your local agent or Farm Credit office, and we'll get out there and help you out.
So, do you have any final thoughts on the year ahead for dairy as we kind of wrap things up here?
Well, I think that this is going to be, again, this recovery year, and that's something we've needed for the last several years, actually, and that's a good thing. But I think we have to be wary as well as we think about just the health of the entire supply chain. These hearings that you talked about, Federal Milk Marketing Order, are likely. I don't have any insights, I guess, that they're actually going to be held, but I think that, the drum beats are starting to be heard now that we need this. So we're going to have to watch and see how that evolves and how that may change the landscape for milk pricing on into the future.
And As you mentioned, with the high-profile bankruptcies of some of the fluid milk processors like Dean and Borden, what do you think that means for processing capacity in the country, I guess, and in the Northeast in particular? I assume that most of these plants are probably going to keep operating under some type of ownership. You know, someone may step in and keep them operating. But do you have any thoughts?
Yeah, first of all, I think that for the most part, producers should not be greatly concerned about this. We should be concerned about that overall category, having some assault on total consumption, but that consumption is still large and it's still there, and it's going to be supplied by somebody, whether their name is Dean or Borden or HB Hood or Byrne or whoever it might be. Those fluid milk markets are going to be serviced by someone. So the worst thing that can happen for a dairy farm, I think, under this reorganization is that we may see closure of some of the plants. And that closure would be plants that maybe aren't performing optimally. Perhaps they're old. They move that volume into other existing plants. So a dairy producer might lose the plant that they've been shipping milk to, and that would mean that their hauling costs could be higher. So that's the one place where I think dairy farmers have some vulnerability.
With that, I think we've gotten to most of the questions that came in, and I thank you for your excellent presentation, Mark, as well as yours, Tristan. And with that, I will sign off. Thank you very much.